Are stock prices about to surge higher? Did Beijing wave the white flag? And what does the ECB taper mean for the dollar? Answer those questions and more on today's show. I'm your host, Steven Van Metre, and thanks for joining me today because we've got some interesting topics to follow up on, specifically what's going on with that Evergrande situation. But before we get into that, are we about to see stock prices head a whole lot higher? Will the bull market end? Well, maybe not just yet. Let's take a look at this article here that's talking about corporate share buybacks are about to or likely to head a lot higher because what you're seeing is a huge amount of corporate bond issuance. And when you look at corporate bond issuance, I'll explain in a moment, there's really something to this and how it transmits into stock prices. We see here this article from Zero Hedge that while traders were focused on today's ECB meeting, which we will talk about, and Treasury yields, also talk about what we have is after 40 billion deals on Tuesday, there was another 28.2 billion across 19 issuers and 34 tranches yesterday, with the early look showing 14 deals in today's pipeline already. And that from Charlie McElligott of Nomura, saying that is just an incredible demand for paper and duration. And so this has caught the attention of BofA credit strategist Hans Mikkelsen, who has noted that the U.S. investment grade issuance for the first 2 days of the week stands at 60.6 billion across a record of any 2-day period, 39 deals. This compares to the previous 2-day record of 36 deals immediately after Labor Day. So what is going on here? Why are corporations borrowing these huge amounts of money, and what are they likely to do with it? Well, we know they don't need it for their operational businesses. We know they have cash flow coming in, so it's not that. We know that's not due to a surge of demand where they're expanding their businesses and new product lines. No. They're going to use a lot of this money to buy their shares back. And this is really important because when corporations buy their stock back, they're indiscriminate buyers. They just have money and they go to the investment bank and say, look, here's a pool of money, start buying these shares back. Now, why does this happen? Well, because corporate executives who have nothing better to do with these companies have turned to financial engineering. And what they do is they grant themselves large stock options, which they can do, exercise based on a certain stock price. So as long as the stock price rises at a certain level, then those options vest, and then the executives need to cash them in because they can make a ton of money. Well, how do you achieve both of those goals? Well, you borrow a lot of money at really ultra low interest rates, and you use that to buy your stock back. That drives the stock price higher and hits your exercise price of your stock. And that triggers your options that now vest. But you need to sell all of these tens or hundreds of millions of dollars that you're due without having a major impact on your stock price. So you continue the buybacks and sell into them, and then you rinse, repeat, and do it again. And all this does is take in account and add more debt to the corporate balance sheet. Now, this, of course, at the time doesn't seem like a big deal. Well, hey, Steve, the economy's doing really well, and if corporations have this cash flow and they have nothing better to do, why is this a problem? And it's not until it becomes a problem. And during recessions, what do you see during recessions? Well, all of a sudden, cash flow for corporations go down as consumers stop spending, which we're likely to see some further signs of that later this month, as we're expecting the fourth consecutive month of a negative month-over-month retail sales print. So we have some early signs that consumers are trenching, we're heading into recession, and yet corporations are borrowing tons of money and likely pointing that toward corporate share buybacks. But when there is a recession and their profits go down, all of a sudden they get squeezed because they've got all this debt on their books that will eventually have to be refinanced. It has to be paid on, and that puts down, ultimately, in the end, during recession, downward pressure on their stock price. So keep that in mind. Maybe for the moment, we do see stock prices go higher, maybe a lot higher. But when the next recession comes, remember, all this debt will weigh hugely on the balance sheet of these corporations and likely send their stock prices much lower. Now, we've been talking and following about this China Evergrande situation this week. And what do we see? Well, looks like Beijing has waved the white flag. They don't want to find out what happens when you get a massive default in the real estate space. So they are allowing Evergrande to reset debt terms to ease cash crunch. This according to Business Times. We see here regulators in Beijing have signed off on a China Evergrande Group proposal to renegotiate debt payments. So isn't that great? The government is stepping in and saying, look, we sense there's a problem here. We're going to force the banks to accept a new deal and renegotiate those payment deadlines with banks and other creditors, paving the way for a temporary reprieve of the cash-strapped developer who has been cut off from the repo market as he struggles to come to grips with more than $300 billion in liabilities. And so this was largely expected to happen, but it just goes to show that when these companies fail, while this may not happen in the U.S. where they directly bail out, in China this is a big deal because this could have been a canary in the coal mine that signaled a massive global recession. China knows that, and they're stepping in. And only if you can imagine you're a creditor, of course, what do you think will likely happen to people who want to invest in this company? Well, they probably won't be too excited about it, knowing the government could change the terms of their payments at any time. Now we'll go and turn to the ECB because what's going on with the ECB is really important. The European Central Bank has starting to taper its balance sheet. Let's head over here to this article. The European Central Bank will trim emergency bond purchases over the coming quarter, it said on Thursday, taking the first small step towards unwinding the emergency aids that propped up the Eurozone economy during the coronavirus pandemic. After the ECB pulled out all the stops and then some last year as the COVID-19 ravaged the economy, high vaccination rates across Europe are bolstering the recovery prospects, and policymakers have been under pressure. Why? Well, this is really simple because everybody thinks that it's quantitative easing that is causing inflation, and they can't see that a lot of it is we're still dealing with the aftershocks from the pandemic. But nevertheless, pressure to taper. Of course, what the question is going to come is, what does this matter with the Fed and the dollar? And so the ECB did slowing the pace of its pandemic emergency purchase program, or PEPP, which kept borrowing costs low as government took the unprecedented amounts of debt to finance the response to pandemic. So we're going to see that happen now. What does that mean for the dollar? Well, a lot of people perceive that what this means is the ECB is going to lead the Fed into a taper. Now, I don't think that's true at all. I still don't think the Fed's at a point that it is going to taper. You have to remember, historically, the Fed doesn't start unwinding until all jobs are recovered. All the ones that are lost are recovered. Maybe that happens in the next couple of months. Maybe it takes a year or more. We still don't know the answer to that question. So why would the ECB be tapering? Is it pressure knowing that the Fed may not? Well, I'll tell you why. It's because everybody wants the dollar to go higher except investors and speculators who believe the dollar is going to go to zeros at some point. And maybe someday it will, but in the meantime, if you are an exporting nation, so you're out in Asia or Europe, and the U.S. economy is looking pretty good, what would you like to do? Get more of your goods and services into the U.S. economy. Now, how do you get Americans to do that, to buy foreign-produced goods and services, to go on vacations and travel and do all that stuff? You do it by weakening your currency relative to the dollar. And that is what we're seeing the taper is likely to do. Because what does quantitative easing do? It traps dollars, in the case of the U.S., or euros into the banking system. So if you're going to trap fewer of those dollars in the system relative to the reserve currency of the dollar, it should put upward pressure on the dollar. So that means it's bullish for the dollar and U.S. Treasury bonds as well. Now, that also, if you understand this, that the dollar can go up here, what will it do to inflation in the Eurozone? Right, it'll drive it higher. We'll likely see more inflation, which is what policymakers want. But what is the counter effect of that in the U.S.? Well, that would be disinflationary in the U.S. as the dollar goes higher. So keep that in mind. What would that mean for the U.S.? Potentially bearish for commodities. Maybe we're seeing that in gold already, and perhaps also could affect stocks. Of course, we know that corporate share buybacks are high and are likely to go a whole lot higher. All right, let's take a look at the next piece we have here, which is how the child tax credit is being spent. Now, some people are talking about how this is going to lead to rampant inflation. Now, you understand, sustainable inflation has to be from the discretionary side of spending. It has to come from discretionary goods and services. So what are we seeing? That a lot of this child tax credit And this is good news that it's going to food. So that means food prices are likely to stay elevated as people can afford to pay the higher prices due to the tax credit that they're getting kind of early, if you will. It's going to clothing, probably for their child, utilities and telecommunications. Again, not discretionary. School books and supplies, not discretionary. Rent, childcare, mortgage. So it's going to the intended purposes that it needs, which is great. So will we likely see inflation in some parts of the economy, such as food? Yes. Will we see it in others? Well, it's unlikely to filter through. Let's take a look at the economic data. Now, one thing we did not mention that is worthwhile is we got to go back to Monday real quick to go to France. And what do we see in the Eurozone here? Well, maybe I'm missing it. Is the import and export data? Maybe that is, what anyways, I don't remember where it is. Anyway, I thought it was on Monday, but what's important about the import export data is if you're looking at an economy, whether it's a U.S. economy or a foreign country, you want to see imports and exports continue to grow. And in France, they're flatlined. Now, month to month, it can change, but you're looking for a trend. And they flatlined back last month. And that's not a good sign if you're looking for continued expansion in the global economy. All right, so into the Thursday data. What do we have here in the U.S.? Well, we've got the pandemic unemployment claims, which I forgot to pull up. So we will just go ahead and grab that real quick on the PUA. Not there. Here's my macro folder. And then we got pandemic unemployment claims from the Department of Labor. And what do we see here is initial claims dropped to 310,000, which is good news, still well above where it needs to be, down in the low 200 or high 100,000 range, suggesting that still the next non-farm payroll report will not be super exciting. The good news out of this report is total claims, including all forms of pandemic unemployment insurance, dropped 255,000 to just under 12 million. Keep in mind, these pandemic benefits ended on Monday, so in the next week's report, well, they should be zero if all goes as expected. Let's take a look at consumer credit. We're seeing a slowdown now. We look at the weekly consumer credit data. We'll probably look at that on Monday. We're seeing it grow, but we're not seeing it grow at a really fast rate. And here you can see revolving debt is still growing. It's positive month over month, but it is slowing. We look at the non-revolving debt. It's growing, but it too is growing at a slower rate. All right, let's move on into the crude oil data, and everything looks pretty good there. The inventory levels are below their 5-year average, which is generally bullish for the commodity. We're seeing that not only in crude, but we're also seeing that in products as well. Let's talk about the recent bond auctions. We saw the 10-year was just huge demand from foreign investors, and we've talked about this, and I want to review it. Here you can see indirect bidders taking a ton of this auction. Strong bid to cover, which is looking at how many bids to cover the offer at 2.59. Saw a similar story in the 30-year with cent yields crashing as foreign investors took a huge chunk, almost 16.8 billion there, with a bid to cover at 2.49. Now, one thing that we've talked about, and I want to remind you about, is these standing repo facilities and what the Fed's trying to do. They're trying to get people to give up their Treasury bills and buy more notes and bonds. And what they're incentivizing people to do is by creating full liquidity across the curve, meaning at any point, notes or bonds can be turned into the Fed to borrow cash at a rate of 0.25% or 25% basis points per year. So if you have a 3-year note or longer, or 20-year bond or longer, you can buy that, hold on to it, and get the cash you need through the Fed's repo facility without having to sell it, such that it's saying don't bother going and buying the T-bill at ultra low rates. In fact, get rid of your T-bills, and you can increase the duration of your portfolio by buying these notes and bonds. And just to review this, we saw this standing repo facilities happen. They became permanent back in July 28th. Of this year is the FOMC on Wednesday, of course that was back then, announced the establishment of 2 standing repo facilities, a domestic and a foreign one, and these facilities will serve to backstop money markets and support the effective implementation of monetary policy and smooth market functioning. As I have suggested to you, I think is to help create demand at the middle and the long end of the Treasury curve. We're starting to see that in the auctions, and it makes perfect sense. And what does that translate to in terms of where yields and bond prices are headed? Well, if the dealers are taking less at the auction and the Fed is not changing its purchasing, that means the dealers are going to go out and have to source more notes and bonds to sell to the commercial banks, who will create bank reserves, and then they will get swapped with QE. And ultimately what this means is strong demand from foreign investors plus a shortfall in terms of how much dealers are taking versus what the Fed is buying. That means everybody continues to fight the Fed because it should suggest that yields go lower and bond prices higher. Of course, it's why we're sitting back at the racetrack, because after yesterday's big move, well, we're getting the setup to see bond prices go higher. Sellers haven't given up, but we'll talk about that on the Sunday night chart show. All right, let's continue on with our story because we've got the producer price index here on Friday. Let's take a look at where it is at. And well, before that, we've got German CPI month-over-month 0 in August. So if you're looking for our inflation win from that is a disinflationary move from 0.9 down to 0. The year-over-year rate of change still ticked a little higher, but boy, if you have 0% month-over-month, the year-over-year trend's not going to continue too much longer. Let's take a look at the U.S. where producer prices rose at 0.7%, slowed from the month before, but still running pretty hot. Year-over-year change up to 8.3%. Take out food and energy, and what do you have? An increase of 0.6%, bringing core PPI in a year-over-year up to 6.7%, which numbers are still really high. Let's take a look at some of the charts here. We've got U.S. PPI final demand versus CPI. Now, many people think that will send the CPI higher. It doesn't necessarily mean that it will, even though you're seeing on this chart, they look very similar. It does suggest that consumer prices go higher if consumers are willing to pay for them. That remains the big question. And we see in the PPI pipeline what is predicted of where producer prices are likely to go. We see final demand here in blue, and we see the pipeline up here suggesting that producer prices are going to go even higher than now. And of course, that starts to look like, well, what you see happening in the great financial crisis, where producer prices went up, consumer prices went up, and of course, you had the tightening of financial conditions. Consumers could not afford it. And then all of a sudden, you get a great financial crisis. Of course, we look back here, and what do we see? CPI went up. Consumers couldn't afford those higher prices, eventually get rejected. We get deflation. And all of a sudden, you see the setup for the next rendition of the great financial crisis. And here we see the U.S. CPI year over year subtracted off PPI final demand. What is this chart telling you? Is that producers are taking a hit at the margin, meaning they are unable to pass these higher prices on. Now they want to, they're hoping to, but without all of these extended unemployment benefits, the question is, will they be able to? Or, if you're thinking about this from an investment perspective, in your stocks, and you think about profits and you think about earnings, well, if manufacturers cannot pass these higher prices on, well, that has a big impact on their future earnings. So keep all of that in mind. Of course, we'll be back on Sunday for the chart show. Again, I appreciate all of you being fans, watching the show, supporting the show. And then, of course, Monday, we'll be back with the regular show. And we will see you then, and I will look forward to it. I'm Steve Van Metre. Thanks for watching. Bye now. The content of this video provides educational information only, is not intended to provide investment or other advice. It should not to be construed as a recommendation or solicitation, buy or security, financial instrument, or participate in any particular trading strategy. This video was prepared by Steve Van Metre. Personal capacity opinions expressed in this video that do not reflect the view of Atlas Financial Advisors, Inc. or Steven Van Metre Financial.